In this video, we are going to discuss the income statement and how to read it. And the first question to start with is, why do you need, in fact, to read any income statement? You might be a business owner and you are just lost in all of that financial data, or you're just interested in investing in a company and not quite sure if that's the best choice. There are three main financial statements that you should know about. They're called the income statement, balance sheet, and cash flow statement. Today, we're gonna go through the main concepts of the income statement. We will cover the other two in more details in future videos. If you'd like to watch those, then consider subscribing. The income statement is a summary which tells us how much money the company earned or lost during a set period of time. Using it, you can determine such things as company margins, its return equity, and lastly, but most importantly, the consistency and direction of its earnings. Back to the income statement. It has three basic components. The first one is revenue of the business. Then is the firm's expenses, which are subtracted from the firm's revenue, and that tell us whether the company earned a profit or had a loss. Sounds simple, doesn't it? Let's go through that more in depth and see how it is actually calculated. And what we need to do is categorize our expenses. Cost of sales is a direct operation cost. General, administrative, marketing, depreciation, and amortization are indirect operating costs. And finally, we have interest expense and tax, which are indirect non-operating costs. Just want to quickly note something that you should be careful about with amortization and depreciation. If the long-term assets they relate to are not used in operations, then these are also gonna be indirect non-operating costs. Now, what we're gonna do with these is put them in the corresponding sections of the income statement, starting with the revenue of 10 million, less 2 million in a cost of sales, which is a direct operation cost, which gives us a gross profit of 8 million. Then we deduct operating costs of 1 million to reach an operating profit of 7 million. And below that, we subtract the interest expense and tax, which are 700k, which leaves the company with a net profit of 6.3 million. Interesting fact is that Warren Buffett's mentor, Benjamin Graham, when investing, used to focus purely on whether or not the firm produced profit, and gave a little or no attention to the long-term viability of the source of the company's earnings. What if the firm spent a huge amount on marketing or had an enormous bill for research and development? This is why I want to go through the small details with you, so we can take a look at the bigger picture and not only focus on a single number at the bottom of the income statement. In the next few videos, we're gonna deep dive into the income statement and analyze every individual component of it and what is the actual impact on the net profit. Take care and see you then.